Welcome back to the channel. I'm Algabot, and today we're studying an expert advisor for MetaTrader 5 called the Derivative Oscillator Pullback. This is a trend-following strategy that waits for a healthy pause inside an existing trend and then looks to re-enter as momentum resumes. It's built on Constance Brown's Derivative Oscillator, a smooth momentum tool that reads the market far more cleanly than a raw indicator. Over the next few minutes, we'll break down how the oscillator is constructed. Let's start with the big picture. The Derivative Oscillator Pullback is a trend-following, pullback timing strategy. Its whole philosophy is that markets spend long stretches trending, and one of the most studied ideas in trend trading is entering. Let's walk through the exact logic, step by step. Everything happens once per newly closed bar, so the strategy is patient and never reacts mid-candle. The first step is building the oscillator. The strategy computes a relative strength index with a default period of 14. It smooths that with a first exponential average of 5, then smooths the result again with a second exponential average of 3, giving the double smooth relative strength index. Finally, it subtracts a 9-period simple moving average of that smooth series. The difference is the derivative oscillator histogram, a low noise, low lag momentum reading centered on 0. Next comes the regime check. The strategy calculates a long price exponential moving average, 100 periods by default. If the last closed price sits above that line, the market is treated as an uptrend and only long setups are allowed. If price is below the line, it's a downtrend and only short setups are allowed. If neither is clearly true, the strategy simply stands aside. Now the pullback requirement. Inside the trend, the histogram must have actually moved against that trend. For a long, the oscillator must have dipped below 0 by at least the minimum pullback depth, a default of 0.20, somewhere within the last 6 bars. That proves a real momentum pause happened, so the strategy is buying a dip, not chasing an overextended move. For a short, the mirror applies. The histogram must have popped above 0 by that same depth. Then the entry signal. The histogram must cross back through 0 in the trend's direction on the just closed bar. For a long, the oscillator moves from at or below 0 to above 0, meaning the double smooth relative strength index has reclaimed its signal line and upward momentum is resuming. For a short, it crosses from at or above 0 to below 0. When the regime, the pullback, and the 0 cross all line up, the strategy opens a trade. Risk is handled with the average true range, so it scales to any symbol or time frame. The stop loss is placed a multiple of the average true range from entry, 2 times by default. The take profit is set at the reward ratio, 1.6, multiplied by that stop distance. Only one position per magic number is held at a time, and a spread filter skips entries when the spread is wider than the allowed points, keeping fills realistic. From there, the stop and target manage the exit. Let's read through the code the way you'd see it in MetaEditor. At the top are the input parameters, each matching the C# strategy 1 for 1. The relative strength index period is 14. Then the 2 smoothing lengths of 5 and 3 build the double smooth series, and the signal period of 9 forms the histogram. The trend period of 100 defines the regime, the pullback lookback of 6, and the minimum pullback depth of 0.20 govern how deep and how recent the dip must be. The average true range period, the stop multiple of 2, and the reward ratio of 1.6 control risk, while the spread filter and lot size round things out. Now the long block. The condition reads, if uptrend and cross up and dip for long are all true. That means price is above the trend average. The histogram has just crossed back up through 0, and it genuinely dipped against the trend within the recent window. When all 3 agree, entry is taken at the ask price. The stop loss is the entry minus the average true range multiple. The risk is that distance, and the take profit is the entry plus the reward ratio times that risk. The trade.by call then submits the order. The short block is a perfect mirror. If downtrend, cross down, and pop for short are all true, entry is taken at the bid. The stop sits above entry by the same average true range multiple, and the take profit is placed below by the reward ratio times the risk. The trade.sell call submits it. Both sides share the identical, symmetric structure. Let's walk through this chart candle by candle and study both a long and a short example. On the price panel, you can see the blue trend exponential moving average line. In the lower panel is the derivative oscillator, our gold histogram, with a dashed gray zero line in the middle and the small pullback depth bands at plus and minus 0.20. Look at the first two candles. Price is climbing and sits clearly above the blue trend line. So the regime is an uptrend and only long setups are allowed. Down in the oscillator panel, the histogram is above zero in the green momentum up region, confirming healthy upward push. Now watch candles 3 and 4. Price pauses and pulls back, and this is the important part. The oscillator dips down below the zero line and pushes past the minus 0.20 depth band. That is exactly the against trend dip the strategy is waiting for. It proves a genuine momentum pause happened rather than an already overextended run. The strategy files that dip away as a valid pullback within its 6-bar window. On the 5th candle, momentum resumes. Price turns back up, and the histogram crosses back up through the zero line into the green region. That is the moment all three conditions agree: uptrend, a genuine dip, and the zero cross upward. You can see the buy entry marker print right there. The stop loss is placed a couple of average true range units below, structurally beneath the recent pullback low, and the take profit sits above at 1.6 times that risk distance. Follow the next candles up. Price pushes higher with the histogram staying positive, and by the 7th candle it reaches the take profit target. That completes the long example. Wait for the trend, wait for the dip, enter as momentum returns, and let the reward to risk target do the work. Now the market rolls over. Around the 8th candle, price falls back below the blue trend line, so the regime flips to a downtrend and only short setups are now allowed. Watch the oscillator on the 9th candle. Price stages a small bounce against the new downtrend, and the histogram pops back up above zero, past the plus 0.20 band, into the green region. That is the against trend pop the short side needs. Then, on the 10th candle, the bounce fades and downward momentum resumes. The histogram crosses back down through the zero line into the red momentum down region. All three short conditions now agree: downtrend, a genuine pop, and the zero cross downward. The sell entry marker appears. This time the stop loss sits structurally above the little bounce high, and the take profit is placed below at the same 1.6 reward ratio. From there, price slides lower through the final candles, the histogram staying negative until it reaches the take profit target on the last candle. Notice how symmetric the two trades are. In both cases, the strategy respected the trend, demanded a real pause of at least the minimum depth, and only acted when the derivative oscillator crossed zero in the trend's direction. That is the whole idea, timing the reentry on the pause rather than chasing the move. So that's the derivative oscillator pullback. We covered how Constance Brown's derivative oscillator is built from a double smoothed relative strength index minus its signal line, how the trend exponential moving average sets the regime, how the strategy demands a genuine against trend dip and then a clean zero cross to time the reentry, and how the average true range stop and reward ratio target manage every exit. We read through the code for both the long and short sides and studied a full chart example. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like us to explore next. You can find more at www.algobot.live. Remember, everything here is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Trade responsibly.